Canadians pay federal and provincial taxes on the income they earn. But when you contribute to an RRSP, your taxable income is reduced. You're saving money before it's taxed, with the intention of using it as a source of income in retirement. This is called tax deferring, because you'll be paying income tax on your savings later in exchange for having your taxes refunded or reduced now. How much of a tax refund or reduction you get depends on how much money you contribute to your RRSP, which we'll talk more about in Part 3, as well as how much income tax you pay, which can vary from person to person and from year to year. In order to know if contributing to an RRSP is right for you, it's helpful to understand how income tax rates work in Canada. To illustrate, let's talk about federal income tax. Imagine the income you earn as water coming out of a tap and filling a cup. Everyone pays a federal income tax rate of 15% on this first cup of income, up to a certain dollar amount. Note that this limit may change every year. If your income exceeds this amount, the next portion of your earnings flow into another cup, where they're taxed at a rate of 20.5% up to the next threshold. And if you have earnings beyond that, the exceeding amounts will be taxed at even higher rates. These are referred to as tax brackets. In addition to these federal rates, each province and territory has its own tax brackets, which work the same way. The higher your tax bracket, the bigger your tax refund or reduction will be when you contribute to an RRSP. A $1,000 RRSP contribution from someone in the highest tax bracket results in a federal tax refund or reduction of $330 because they pay 33% tax on their last dollars of income. Whereas a $1,000 contribution from someone in the lowest tax bracket results in just $150 tax dollars refunded or reduced, because they pay only 15% tax on their income. As a rule of thumb, it's beneficial to contribute to an RRSP when your income is higher and withdraw money when your income is lower, which is often the case in retirement. You can also make RRSP contributions in the current year and save the tax deduction for a future year. These are called unused RRSP contributions. You might consider this option if you think you'll be in a higher tax bracket in the future, but still want to take advantage of tax-sheltered compounding today. Learn more at GetSmarterAboutMoney.ca, brought to you by the Ontario Securities Commission Investor Office.